Hello and welcome to our short video on the Conceptual Framework. The Conceptual Framework's pretty fundamental to general purpose financial reporting, so it's something we do need to know about. It sets the framework for how we go about putting together a general purpose financial report. The Conceptual Framework, which we use, is the one that comes out of the International Accounting Standards Board in London, and all countries that have adopted IFRS, International Financial Reporting Standards, also adopt the Conceptual Framework because the accounting standards are built or developed upon what is in the Conceptual Framework. It's a building block for general purpose financial reporting. It's not an accounting standard. Accounting standards override the Conceptual Framework. The Conceptual Framework gives us the fundamentals. So it doesn't drill down onto things like how do I account for inventory or how do I account for research and development or things like that. It's a more general document. As I've said, it focuses on general purpose financial reporting, which is reporting aimed at users who wouldn't otherwise have the power to demand information to specifically meet their needs. So a general purpose financial report would be the sort of report that a large public company would release to its shareholders. As a shareholder certainly of a big public company, I don't have the power to go and demand information to suit my specific needs. So I rely on a general purpose document which will suit most of my needs as it will suit most of the other shareholders' needs and most of the other lenders' needs and so forth. Now the Conceptual Framework is built on a logical structure and it goes through a number of steps or building blocks. So the first thing the Conceptual Framework does is define what is a general purpose financial report. Okay, and again, they're reports aimed at users who wouldn't otherwise have power to demand specific information. So we're not talking about special purpose financial reports, we're talking about general purpose financial reports. And as I said, they're generally issued by larger organisations that have many users who need the information to make decisions, but who otherwise don't have the power to individually demand information to satisfy their own needs. Now, as I said, there's a logical sequence in the Conceptual Framework. So first of all, as I said, we define what it is, then we talk about who are the users. Okay, so if we're going to put together a general purpose financial report, who is that report aimed at? And under the Conceptual Framework, it's indicated, or it's stated that the users are investors, potential investors, lenders and creditors. So it's very much aimed at those with a financial stake in the organisation. Once you talk about users, you have to make some sort of judgment. What sort of knowledge do they have? Okay, so if I write any report, I've got to take into account the knowledge of the users. The Conceptual Framework takes the view that people who read general purpose financial reports are supposed to have a reasonable understanding of financial reporting. So they're not aimed at people who have no knowledge at all. Now, once we've worked out what general purpose financial reporting is, who are the users, the next thing to talk about is the objective of general purpose financial reporting. And the Conceptual Framework identifies basically two main objectives. A general purpose financial report should assist people to make resource allocation decisions, such as should they invest in a company, should they loan funds to a company. And the other objective, which was reintroduced in the most recent changes to the Conceptual Framework, and the major recent changes happened in 2018, is to reintroduce the notion of stewardship. So it also says that general purpose financial reports have the objective of showing how managers have utilised the funds that have been entrusted upon them. So stewardship is quite an important component of the Conceptual Framework, and it wasn't there before. Well, it was there years ago, was taken out in 2010, has recently been reintroduced. Okay, so we've talked about the objective. The next thing you're going to read about is what characteristics should information have to be useful. So the Conceptual Framework identifies some fundamental qualitative characteristics that information should possess if it's to be useful, and they are relevance. So information should be relevant. Okay, and that makes sense. Something is relevant if it makes a difference. So if I'm going to provide information to you, that information must be able to make a difference to your decisions. Otherwise, why would I provide you with the information? So that's the first fundamental qualitative characteristic that useful information has. The second one is representational faithfulness. General purpose financial reports should report information that's representationally faithful. What we might have once referred to as reliability. And that means it should be complete, neutral, ideally free from error, and so just totally unbiased. So for information to be useful, it should be both relevant and representationally faithful. There's no point giving someone information that's possibly quite relevant, but it's unreliable. They'll make wrong decisions, and that's not good for anyone. If something's not relevant, then why give it to them in the first place? So you really need to have both things in place. Now, once we've defined the qualitative characteristics, the conceptual framework says, well, what do we actually report? What are the elements? And as we should know by this stage of our education, the elements are assets, liabilities, expenses, income, and equity. And the conceptual framework provides definitions and also recognition criteria. So we need to know the definitions. So for something to be recognised, it must satisfy the definition of the respective element, and it should satisfy additional recognition criteria. So if it's an asset, there's three key things within the definition. It's got to provide future economic benefits, and it's got to be as a result of a past transaction or event, and the organisation has to have control over that resource. So if you don't control something, it's not your asset. And that has some fairly big implications. But again, you need to understand the definition of the elements, and you need to understand when we recognise them. Okay, when do we put them in the financial statements? Okay, so once we've gone through all that, you need to read through it and understand the different building blocks. So again, we've said the characteristics that information should have, which are relevance, representational faithfulness. We've talked about the other enhancing qualitative characteristics. We've said these are the elements. That's all fine, but what amount do I attribute to the relevant element? Okay, so if I'm going to put an asset in, we need to know then about measurement. Now, the conceptual framework doesn't really tell us a lot about measurement. We need to go to individual accounting standards, and we'll address those in the rest of the chapter. Now, at the end of the chapter, there's a little bit of material on the limitations of the conceptual framework, and one I want you to think about is to do with the way we define assets. Okay, for me to record an asset within a general purpose financial report, I must control the asset. Okay, if I don't control it, it's not my asset. Now, part of the recognition of an expense is when we're using up assets. So, throughout the book, we'll talk about some social issues like climate change as well. If I release a whole lot of carbon emissions into the atmosphere, is that an expense of the business using our framework in the conceptual framework? No. Because the way we define assets, and you really need to understand this, is an asset is something I control. If you don't control something, it's not your asset. If you use it and abuse it, it's not your expense unless there's fines. So some people see that as a significant limitation of accounting. So please read through that, try to understand what I'm talking about there, and just realise that the general purpose financial reports give a good reflection of financial performance using a particular framework, but it's not holistic. It's not a holistic measure of performance. We've really got to look at social performance, environmental performance as well. But we'll talk about that later in the book. Thank you for listening, and be nice to each other.